Thank you, everybody, for joining us for this workshop today, Keys to Home Buying. My name is Stephanie McNeil, and I am a Partner Experience Manager with GreenPath Financial Wellness, which means I get to work with credit unions, just like and including Sparrow, who partner with GreenPath to come alongside their members on the journey to financial wellness. Next slide. So today we will be talking through the steps home buyers take from preparing to purchase a home to working with a realtor and lender to searching for a home and making an offer. We'll also cover what happens after your offer is accepted and on closing day before wrapping up with some keys to successful home ownership long term. Making the decision to purchase a home is an exciting but potentially overwhelming time. Houses are typically the largest purchase many people make, so you want to be sure you are as prepared as you possibly can be as you enter this process. The first thing you'll want to do is work on gathering the documents you will need when working with a mortgage lender. Exact documentation needed may vary, but typically includes at least 1 to 2 years of W-2s and tax returns, at least 30 most recent days of consecutive pay stubs or other sufficient proof of income, at least 2 consecutive most recent months of bank statements, as well as statements for any investment or other assets that you have. If a relative or someone is gifting you funds towards your home purchase costs, they will need to write a letter guaranteeing it is a gift and is not a loan from the individual to the home buyer. You may also be asked to share proof of your rental payment history, especially if you're applying for an FHA mortgage. So once you've gathered all of your documents, you use them to determine and create your budget. Yes, start by reviewing your income and determine your net income, which is the amount of money you'll actually take in after taxes and deductions are subtracted. And then next, you're going to list all of your expenses. So you'll use your statements to review spending and determine actual amounts for each expense category that you have. It is helpful to look across multiple months to find an average, as expenses, they do vary from month to month. And then your goal here is to have a solid understanding of where every dollar you earn goes so that you know how much money you can afford to spend comfortably on a potential mortgage payment. And then once you have developed this list of a budget and know how much you estimate you'll be spending on each expense category, you'll spend a month or two tracking your spending carefully to ensure you have captured all the expenses accurately and confirm you're comfortable with the budget you have developed. This will be a key step in determining how much money you can truly afford to as you start looking at homes. It's also recommended to review your credit reports as soon as you start thinking about purchasing a home. You can review your credit reports from all 3 credit bureaus, TransUnion, Equifax, and Experian, for free at annualcreditreport.com. Reviewing all 3 reports is important because some creditors may not report to all 3 bureaus, so information varies across the 3. Reviewing all 3 reports will help you have a clear picture of everything reporting under your name. If you find any errors or inaccurate information, you can file a dispute with the credit bureau directly. This process can take a bit of time, so the sooner that you can start this dispute process, the better, to avoid holding up the mortgage application process. If you have negative items on your credit report that are legitimate, those will not typically be able to be successfully disputed. You can, however, add a notation to your credit explaining the negative items, especially if there was an emergency or a situation out of your control that led to accounts falling past due. This notation will not impact your credit score or remove the negative item, but it can give some context to the mortgage lender reviewing your credit to take into consideration. Once you have laid the groundwork and you are ready to start taking some concrete steps towards finding and buying a home, you will want to find a realtor and a lender to work with. These individuals will be guiding you through this large purchase, so you will want to be sure you trust them and feel comfortable working really closely with them. When looking for a realtor, it's a good idea to start by asking friends and family in your area who they have had good experiences with. Just as important, be sure to find out if there is anyone you know who has had negative experiences with a local realtor. You can also search online for recommendations of local realtors in your area. Be sure to read reviews carefully and do thorough research before making a choice. Consider interviewing a few realtors to decide on who might be the best fit for you, especially without personal recommendations from friends or family. And then as you research and interview potential realtors, it's important to make sure they have proper credentials. Of course, reputation is important, and you want to be sure they have the proper expertise to guide you through this process confidently. What experience do they have in real estate markets that you are planning to purchase in? In addition to finding a realtor to guide you through the process, you'll need to find a lender to help you finance the purchase. Start your search by meeting with the mortgage department at your credit union or bank. This is a lender you already have a relationship with and you trust, so this is a perfect place to actually start. If you want to search around and compare rates across different lenders, get all your ducks in a row and submit your applications within a short time period to limit the credit impact. If applications are spread out over several months, you may start to see your credit score drop due to multiple hard inquiries over a longer period of time. If the inquiries are close together, ideally within like a 1 to 2 week time frame, it will be obvious that you are rate shopping and will not have the same negative impact on your credit score. Before starting your home search process by looking at specific homes, apply for pre-approval. This will help you know for sure how much financing you will be able to get, so you know what price range you're able to search within. It's imperative to get pre-approved before looking at homes to prevent the deep disappointment of falling in love with a home that is outside of the price range that you're able to get a mortgage for. It can be exciting to start looking at specific homes, but definitely don't skip this pre-approval step. A pre-approval means that a lender is tentatively willing to finance a mortgage up to a certain amount. This is not a guarantee that you will for sure be able to get this loan, but it lets buyers know you have started the process and have a reason to believe that you should be able to obtain sufficient financing when you make this offer to them. It can be a leg up if you place an offer on a home that has multiple offers. A pre-approval gives the seller confidence that you are likely going to be able to move forward to close. Final approval will come after you found a specific home and you move forward with requesting a mortgage for that specific home. When issuing a pre-approval, it is imperative that you know what you can comfortably afford in your budget first. A lender typically won't look at all of your living expenses, so they may pre-approve you for a loan that is more than you can comfortably afford in your monthly budget. So know what you are comfortable spending overall on a home, as well as what you are comfortable spending on a monthly mortgage payment, and share this with your lender upfront. Just because you're pre-approved for a certain amount does not mean that you can comfortably afford it. And you'll also need to be prepared with sufficient savings for a down payment, closing costs, and other upfront expenses that can vary depending on how much you are purchasing the home for. This will also be important to consider when determining for sure what price range you can afford to search for homes within that price range. And finally, it's important to know what your property taxes and homeowners insurance, which are typically included in your mortgage payment, are likely to change over time. When figuring out what monthly amount you are comfortable spending in your budget, be sure there is wiggle room for that payment to increase without causing a whole lot of strain. This can happen as soon as the first year after buying your home. All right, once you've chosen a realtor to work with and you have identified the price range you are comfortable with and received a pre-approval from at least one lender, now it's time for the fun part, searching for your home. It's unlikely you will find your perfect dream home that checks every box on your wish list, so it's important to think about what are non-negotiables and what are nice-to-have features that you are willing to budge on. Choosing a location is one of the first decisions you'll need to make as you start your search. What neighborhoods would you like to purchase in? Do you have or plan to have a family? What school district would you like to be in, and how close would you want to be to the school that your kids would attend? How far away from work are you willing to live? Are there public transportation options that you can get you to work easily if this is important to you. What are property taxes like on average? Taxes can vary significantly in some areas. If the property taxes increase or are higher than expected to begin with, it could break the budget, as it may lead to mortgage payment that is out of range for you, or something that you're comfortable spending, even if the purchase price ends up being right on the money. It's also helpful to think about what other places you frequent and determine how close to or how far away from those places you would like to live. So consider what other things you would like to have or like to live near, maybe like parks, libraries, grocery stores, public transportation, and anything else that is important or a priority to you. And finally, when choosing a location for your new home, it can be helpful to look into things like noise and traffic levels, as well as safety considerations. Beyond location, you'll also want to identify what are the needs and what are the wants. Start by considering things like number of bedrooms and bathrooms. What's an ideal number and what is non-negotiable number that meets your needs? You might also want to think about certain square footage needs, as well as what style of house you're interested in pursuing. A single family home, a duplex, townhouse, condo, 1 or 2 stories. You may also want to consider the aesthetic and floor plan styles that you like as well. Do you love to be outdoors? Do you dream of planting a huge garden or have rooms for your kids or pets to run around freely? Outdoor space is another thing to consider. Is that more of a need? Is that more of a want? It's definitely something to consider. The kitchen is another key thing that many people have needs and wants related to. Take the time to determine what you need, what you want, and what you may be willing to compromise on, but could potentially also modify later on down the road. What other features of a home are needs for you and your family? Identify these non-negotiables and share them with your realtor so they can help you search for homes that definitely meet those needs. All right, once you find a home that meets your needs and hopefully many of your wants, it's time to make that offer. When determining what to offer the seller, you will want to consider what purchase price you would like to ask the seller to agree to. Your offer can also include any contingencies you may want to include, which can range from agreeing that the buyer can bow out without consequences if the appraisal comes in low or the inspection indicates drastic repairs, to agreeing that the buyer has time to sell their current home before closing on the new one. The buyer may also want to request certain concessions from sellers in their offer, such as seller's assist that would cover some of the buyer's closing costs and reduce the amount of cash a buyer would need to close. There are limits to the percentage of costs a seller is allowed to cover, so be sure to talk this through in detail with your realtor. And your offer can also include when you would like to close on the home and move into the property. You can also provide the buyer with a deadline to respond to your offer, as well as indicate how much money you are willing to put down as an earnest money deposit. This indicates to the seller that you are a serious buyer and plan to move forward with the purchase, giving them reason to confidently remove their home from the market. Any earnest money deposit you put down goes towards your closing costs or down payment at the time of purchase, reducing the amount of cash that you end up needing to close. All right, once you've submitted an offer on a home and you are excited about it, hopefully it will be accepted by the seller. There may be some negotiation, which you can work on with your realtor. Once your offer is accepted, there are some important steps that you need to take to close the deal. The first step is to actually fully apply for a mortgage with the lender of your choice that pre-approved you. There are a variety of mortgage types available, and your lender can help you determine which might be right for you. The most common mortgage type is what is known as a conventional mortgage. These tend to have stricter lending requirements and are typically an option that makes most sense for someone with a high credit score. An FHA mortgage is designed to make home ownership, possible for more people, including those with slightly lower credit scores or lower incomes. These mortgages are backed by the Federal Housing Agency. With a lower down payment and credit score requirements, FHA loans can be a great option for many first-time home buyers. If you are a veteran or active duty service member, a VA mortgage may be a great option for you. National Guard and Reserve members may also be eligible. VA loans allow you to purchase a home with no money down, competitive interest rates, and oftentimes limited closing costs. Veteran or service members may obtain a certificate of eligibility through the VA, and your lender may also be able to help you obtain that. Other government-backed mortgage is called the USDA loan, which is specifically for properties that fall in defined rural areas. Buyers must meet a certain income requirement but are eligible for 100% financing, meaning no money down. The home must be located in a USDA eligible rural area to qualify for this specific mortgage type. When applying for a mortgage, you may also be offered a fixed rate option and an adjustable rate option. A fixed rate mortgage means the interest rate will remain the same for the life of the loan, while an adjustable rate mortgage may change over time. Typically, adjustable rate mortgages offer one rate for a specific defined period of time, after which the rate may change to match market rates. This could mean that your rate decreases or increases. While considering whether a fixed rate or adjustable rate mortgage makes sense for you, it can be helpful to think about how much time you plan to stay in the home. Talk this through with your lender. If you plan to stay 5 years or less, it may make sense to weigh your options more carefully. One thing that can be helpful to understand is the difference between APR and interest rate. The interest rate is the percentage you are required to pay to borrow the money for a period of time. The APR includes the interest rate, but also adds on any other fees that you will pay the lender in order to better represent the total annual cost to borrow this money. Comparing APRs when choosing a lender can give you a better idea of the more affordable option compared when looking at when looking at just interest rates, When it is possible to get a mortgage with less than 20% down, you will typically be required to pay for additional insurance that protects the lender because they are taking on more risk by lending you more of the home's value. If something were to happen and you were to default on the mortgage, the lender is at a higher risk of loss. This insurance is called PMI for conventional loans or MIP for FHA loans. PMI, which is short for private mortgage insurance, is typically required if you obtain a conventional loan with a down payment lower than 20%. Once you reach 20% equity in your home, you can reach out to the lender and request that your PMI be canceled. If you don't proactively request the cancellation, it will be automatically removed once your loan's principal balance reaches 78% of the home's original value. Mortgage insurance premium, known as MIP, is required for all FHA loans, regardless of how much money you put down. A key difference with MIP compared to PMI is that FHA loans require not just the annual MIP, but also an upfront payment as well. This upfront MIP can be financed as part of your loan, and both MIP and PMI are typically paid as part of your monthly mortgage payment. Another key difference is that MIP will typically be required for the life of the loan unless your payment was 10% your down payment was 10% or more. If you made this size of a down payment, your MIP will cancel after 11 years. If your down payment was less than 10%, your MIP will not cancel until the loan is paid off, or if you were to refinance to a conventional loan after reaching at least 20% equity. Typically, your monthly mortgage payment includes 4 main components: principal and interest, as well as taxes and insurance. We just talked about one form of insurance, but you will also need homeowner's insurance for any mortgage and will have property taxes to pay as well. While property taxes and homeowner's insurance are typically paid out once a year, you can pay towards that annual amount on a monthly basis as part of your mortgage payment. This goes into what we call an escrow account. which your mortgage company will hold onto and then use to pay your taxes and insurance premiums when they come due at that one point a year. Once a year, your lender will also review the escrow account to determine if a sufficient amount is collected to ensure the taxes and insurance can be paid on time. They will send you a notification letting you know if your mortgage payment will increase or decrease to maintain future payments. It is important to know that this can happen as soon as the first year of you owning your home, so be prepared for this as a possibility. When determining whether or not they can extend a loan to you, underwriters look at a variety of factors. The first of which is capacity. Do you have the ability to repay this loan if they extend it to you? Underwriters will review your income and employment history, how much money you have in savings, your current monthly debt payments, and other financial obligations. They will review how the requested mortgage payment fits in with this to ensure that you are likely capable of financially managing all of your obligations. The second thing that an underwriter will look at closely is capital. Do you have the cash or assets available that you could turn to if needed to meet your obligations to repay this loan? This also shows a potential lender if you have excess funds available on a monthly basis to save or invest, further proving you can afford to make that monthly mortgage payment. The next thing underwriters will consider is your credit history and score. So this will indicate to the lender how you have managed accounts previously, as well as how you are currently managing credit accounts to indicate how risky it is to them to extend more credit to you. The higher your credit score, typically the more options you have available to you and the better rates you will get. While it is possible to obtain a mortgage with a lower credit score, it is in your best interest to get your credit score as high as you can before applying for a mortgage. And finally, underwriters are interested in the collateral you are pledging in this loan. For most mortgages, this will be the home itself. The underwriters will want to ensure the home is worth enough to cover their losses if you were to fall behind on your mortgage so far that they ended up needing to foreclose. This is typically determined through the home appraisal. All right, once you have submitted a full mortgage application, you will receive a loan estimate. The lender is required to provide this to you within 3 business days after receiving your completed application. This loan estimate is not a guarantee that your loan application is approved or denied, but is designed to give you all the details you need to know if you decide to proceed with seeking this loan, including the estimated interest rate, the estimated monthly payment you can expect, including estimates for the portion that will go to taxes and insurance, and the estimated amount of closing costs and the estimated amount of cash you will need in order to close, which will typically need to be paid by a wire transfer or cashier's check on closing day. The loan estimate will also provide you with any other unique details or expectations related to the loan. This is a document you will want to review thoroughly and make sure you understand fully before agreeing to move forward. All right, so after your loan application is submitted, the next step would be a home inspection. Home inspections are not typically required, but are highly recommended. A home inspection is for your protection as a buyer. It is to help you enter the purchase with a clear idea of flaws or warning signs in the home. You as a buyer will choose a home inspector, so be sure to shop around for one that you can trust. FHA loans may require a specific inspection to ensure the property meets certain standards. It is still recommended you hire your own inspector to take a look at the property thoroughly as well. When you made your offer, you may have included contingencies related to home inspection findings. If an inspection shows a major issue with the system or large repair needed, you may be able to negotiate with the seller to ask them to fix or to reduce the purchase price if you prefer to fix it yourself, or you may have the right to cancel the agreement to purchase a home if you are dissatisfied with the inspection or cannot agree with the seller on resolving those concerns. This is something to talk with your realtor about in detail when submitting an offer to be sure that you are fully covered as a buyer if the inspection reveals major concerns. A home appraisal is different from a home inspection in that the inspection is designed to give a buyer a clear picture of the condition of the home, while the appraisal is designed to give the lender or to let the lender know how much the property is actually worth. The mortgage lender will hire an appraiser and work with you to schedule it. Unlike an inspection, you, as the buyer, you do not pick the appraiser. The appraisal will confirm how much money the mortgage lender can extend a loan to you for based on the value of the property. If the appraisal comes in lower than the amount you are asking to borrow, you will either need to come up with more money to bridge that gap or potentially see if the seller is willing to negotiate. All right, once you have gotten through all of this paperwork, all of the phone calls, the inspection, the appraisal, and gathered the money that you need, it is time for the exciting part, closing day. Leading up to closing day, you will receive some documents ahead of time to review that can help speed up the process a bit at the closing table. You'll want to review these documents closely and reach out to your realtor or lender immediately if something seems incorrect. Legally, you are required to be sent your closing disclosure 3 business days before you are scheduled to close. You will also want to confirm with your realtor the exact location to meet for closing and plan to arrive early. You can also request a final walkthrough of the home, which can be used to confirm the seller made any requests to repairs, make sure the home is still in as good, if not better condition as it was before, and verifies that all agreed upon appliances are remaining in the home. Prior to closing day and receiving your keys, you will need to reach out to the utility companies to schedule all utilities transferred to your name by the day you plan to take possession of the home. Even if your move-in will be delayed, you will still want to move utilities over as of the day the property is officially yours. You will also want to connect with your realtor and lender about what you need to be sure to bring with you to that closing table. This typically includes a valid photo ID for all borrowers and certified or cashier's check if you are not using wire transfer for your closing costs and down payment. So, home ownership. After you've signed more paperwork than you could ever imagine, handed over a large sum of money, and you have your keys, congratulations! You are officially a homeowner. The journey doesn't stop with walking in the front door for the first time, however. Before we wrap up our time together, we want to share some keys to successful home ownership beyond closing day. So the first tip is to prioritize rebuilding your savings as soon as possible. If most of your savings went to a down payment, closing costs, and moving expenses, it can be tempting to jump into renovation projects and improvements, but pausing to get money tucked away again for emergencies is definitely recommended. As a homeowner, when an appliance breaks, you are responsible to fix or replace it versus, being able to call a landlord. It is recommended to map out an annual home maintenance plan. This is something you can research online for recommendations of what to include, when to do it, and how often to do it. Figure out a method to stay organized and keep track of the maintenance completed as well as maintenance that is coming due. And again, as a homeowner, there are more possibilities for emergency expenses than as a renter. It is recommended to keep an emergency fund separate from other savings for things like renovation or vacation. This ensures you have money tucked away for unexpected major expenses that won't be touched until it is absolutely needed. And then as we discussed earlier, your mortgage payment may increase as your homeowner's insurance and taxes change. As you revisit your budget from time to time, keep this in mind to be prepared for a potential increase in monthly payment. Also, as you plan for repairs and improvements, what you want to make to your new home, you want to prioritize any major concerns that the home inspector did find. These may not always be the most fun or cosmetically pleasing improvements, but they can be the most important to take care of first. You may also need to build up savings to take care of larger repairs, so having a plan for this can be helpful as well. And the final key to successful home ownership is to always prioritize your mortgage. A foreclosure can begin as soon as 3 months after falling past due on your mortgage, so making this payment your top financial priority every month is strongly recommended. If you are ever concerned about making your mortgage payment, please reach out to the mortgage company as soon as possible to discuss your options. There may be both short-term and long-term hardship options available, and the sooner that you explore them and make your mortgage company aware of them, the better. You can also reach out to a HUD-certified housing counselor to talk with someone about your housing situation. GreenPath Financial Wellness partners with Sparrow. We have housing counselors on staff who can help you understand your options, come up with a plan, and even help you reach out to the mortgage company to take action. I was actually a housing counselor when I was a counselor at GreenPath, and we can call the mortgage company with you. We know questions to ask that you might not necessarily know. We just really put someone in your corner to help you figure out what you need to know in that sort of situation.